Well, good afternoon, John. It's good to see you. We are recording this on Thursday afternoon, and we had a big night from overseas. The Federal Reserve lowered interest rates by 25 basis points for the first time in 9 months. John, the market response was a little muted. I suppose it was a case of buy the rumor, sell the fact. What were your impressions watching Jerome Powell and what he had to say about the rate cut?
Well, it seemed like the committee was fairly, the majority agreed to a rate cut. There was a couple of outliers. I guess the recent appointee to the Federal Reserve wanted 5 cuts in
Or you wanted
next
a
2
50
meetings.
basis point cut, yeah.
Yeah, so, and there was another outlier on the other side. So, but the bulk of the committee agreed to the 0.25%, and it's likely to be another 0.25% before Christmas. So that's where we sit, and I think the forward markets are there. As you said, I don't think there was any surprises, so the market traders immediately sell the fact, and then they thought about it, and I think what we've been talking about for months, Paul, is coming into play. Concurrently, in the last week or so, we've had budget figures come out. It suggests to me interest rates being cut in America and a massive QE program being introduced at some point in 2026. Budget repair is a long way away in terms of America. Getting interest rates down is important, so long as it's reflected in the bond market. So what we've done is cut cash rates. That's fine. That'll trickle through at some point, but the real issue is when does the bond market rally further? So 10-year bonds around 4.1. Given what we're looking at, that's still too high as American debt has rolled over. So it's work in progress, so to speak. But I think the equity market response is more focused on the long term, which is they expect interest rate cuts right across the yield curve in the next 12 months.
Yeah, and the forward dot prophecies, if you like, or opinions, are that there'll be, as you said, another rate cut towards the end of the year, and then perhaps 2 in 2026 and another 2 in 2027, although forecasting out that far out.
But Paul, it depends on what the Federal Reserve looks like in 2026.
That's true.
And whether the Trump administration forces a control change or leadership change and gets that Federal Reserve to implement an aggressive quantitative easing program. That's what we don't know. We suspect it's going to happen, but it's got to play out. But if it plays out, and I think the share market and indeed the bond market is anticipating that's what's going to happen in 26. If that doesn't happen, that's when you will have problems.
And the US market, forget about the US market, but the US economy actually looks pretty resilient. It's not firing, but it's not particularly weak either. And corporate margins are strong, and it sort of looks okay.
It's okay. It's not fantastic, as you said. I mean, employment numbers, they are still growing employment numbers, but they're not going backwards, would be a recession. But the number of job openings has slowed dramatically over the summer months in America. Unfortunately, we're going to be watching to see whether the American economy can drag itself off the bottom of a slowdown. Not a downturn, but a slowdown in economic activity. Corporate America, as you say, but when you look at the numbers, and I'm going to delve into them in the next few weeks and write some reports prior to going around Australia and talking to clients, there's still, magnification of earnings in very few large multinational companies. The broader American economy is okay, but it's not dynamic.
Yeah. And I suppose the positive with a slower jobs market in the US is that the supply of people looking for jobs has reduced because Trump has put the wall up from illegal migrants and new people joining the job market. So
yeah. But my point is, the next big issue is going to be the effect of the tariffs, the effect of the tariffs on inflation, and the effect of the tariffs on having some effect on the budget of the American government. Now, as at the end of August, the budget of America was heading to $2 trillion again. So that's the latest update. I'm trying to see significance of the tariffs in terms of revenue rate rising. We're seeing some benefit, but it's in the tens of billions. It's not in the hundreds of billions at this stage. So that's important. To rectify the issue in America, it has to be hundreds and hundreds of billions of dollars of tariff income. But as we know, that's tariff income, which is a tax on American consumers. You know, there's no evidence to say that more of that tariff is being paid by the exporters in foreign countries than they are by the importers then pushing it through to the consumer. Then we've got to watch the inflation numbers, and I think Jerome Powell is still saying, look, whilst inflation is trending down, he has more of an eye, as I said in an earlier answer, he's got more of an eye on the slowing of the employment market. So he's got to manage the American economy, he's got to manage employment, and he's got to manage inflation. What I think he said last night is that he's seeing a slowing in the employment rate, which sort of pushed him to cut interest rates. That was his focus last night, but he's also got an eye on inflation.
Yeah. John, let's switch to the domestic market. At 11:30 this morning, we got the labour figures out. What surprising. Employment has stayed at 4.2%, but there were less jobs created than expected. In fact, I think the jobs number actually reduced by 5,000 instead of advancing by 20,000 as the market expected. Australia seems to be sort of going through a bit of a sluggish patch. What did you make of the labour report?
Well, they're 1 month numbers, and we know that they'll be changed in a few months' time. And as you said, we've got unemployment rate steady, and we've got less jobs being created. So, you know, one of those numbers is wrong because it would suggest that less people were looking for jobs.
Well, the participation rate was down.
Yeah. So, those numbers, you can't read too much into them. You want to look at trend lines. I think the trend is that Australia is still going through anemic growth. The trend line is that there was some sort of pickup in consumer and household confidence, retail activity after the interest rate cuts. That's probably going to peter out at some point. We're still seeing a buoyant residential property market, which to some extent is alarming in terms of prices being paid and the multiple of income and the leverage going into new home purchases. We've got a great debate going on in Australia regarding, energy and decarbonisation and net heading towards net zero in 30 years' time. As you say, Australia is just rolling along. There's nothing really happening as these debates, continue.
Yeah, there was the Westpac Melbourne Institute index came out. So that tends to look at leading indicators 6 to 9 months ahead, and that was dripping, sort of tipping over a little bit. Do you pay much attention to those kind of
but
indicators?
I think we're seeing. No, I listen to. They're just indicators, and I don't know how they're like business confidence and all that. But I think we've got a debate going on regarding energy policy in Australia. It's never ending, by the way. And we've got some big announcements coming out today about our 2035 targets and how far they're going to be below 2005 actuals. And I'm not sure why 2005 is so important, but anyway, that's how we do it. And then we're heading towards net zero in 2050. The Liberal Party can't quite work out where they stand on it. But I think the business sector is saying, can we get some certainty here? Because it's very hard to invest when we have no certainty about government policy over the one of the most important issues of Australia, energy and the cost of energy and where it's coming from. Apart from labour costs, Paul, there's nothing more important than the cost of energy in the cost of doing business in this country, and therefore investing for the future, putting capital aside or investing capital, trying to get a return on it and trying to get some certainty about the return you're getting from investing capital. So this great debate, which continues in Canberra about our where we're heading towards net zero and which will lead to an energy cost impost and where the energy is coming from. I mean, running business in Australia today with that sort of debate going on endlessly, we don't reach a consensus, you know. And I blame both sides of politics for this. There's got to be a better way. We need to land on something and get moving on it so the economy can start moving on the back of it.
Well, John, there was a massive vote of no confidence today in the Abu Dhabi dropping its takeover bid for Santos after doing due diligence. So this is a $30 billion potential acquisition, and the Abu Dhabi oil company has had a close look at Santos and decided they didn't like what they saw and has dropped their bid. To some extent, a lot of that relates to uncertainty about government policy, regulations, all the sort of things that you're talking about. And we even saw the Australian dollar dipping. Is this a massive vote of no confidence in the energy policy run by, as you say, both governments?
Well, you'd like to think that part of Australia's energy policy would be Australia owning its destiny in terms of generating energy and not so relying on Middle Eastern conglomerates buying it. I mean, it's great to sell off our assets, but where do we end up in 10 years' time? Now, I go back a long time in stock markets and I look at the share market today with dismay. The lack of alternative investments being presented in the stock market. So to some extent, there's a little bit of joy in my heart about that we're not selling another iconic Australian company off. Now, the reasons why they've walked away from it, you know, who knows? I mean, but to your point, a foreigner buying an Australian energy company with such lack of clarity over what the Australian government's policy is, and therefore the national policy is, I mean, makes some sense to me. I do see that Santos, you know, a lot of analysts are saying Santos, after many years of struggling, is actually performing quite strongly now. And maybe they should continue to perform quite strongly and generate cash and reinvest and pay dividends to Australian owners. What's wrong with that?
Instead of our huge super funds sending 80% of their money offshore to buy American big tech companies.
Yeah, well, I don't think they can buy Middle Eastern oil conglomerates, can they? So we'd be selling an Australian asset to someone who we can't invest back into.
Yeah.
Doesn't make a lot of sense to me in the world today.
John, there was an interesting article in First Links by James Gruber, the editor, wrote about the kind of the excessive, I think the term he used was financialisation of, you know, global markets. There's too much money around and the money is chasing too few assets and it pushes prices up beyond what is reasonable. We can see that happening in Australia with money concentrated in super funds and money concentrated in residential property. Is this a structural issue? I mean, you pointed out in the article that it's distorting prices. You know, where do we go from here?
When you start extrapolating price growth, inflation growth, wages growth, and you start seeing the price of housing in particular growing at 20% faster, doubling, 50% faster, whatever, multiples of income growth, and you extrapolate that out, and I mean, the risk of extrapolation is you're wrong, but if you play the game and you compound these price movements and wage movements, you see that some point between now and 2050, property is going to be ridiculously unaffordable. Now, either we decide that it's not going to correct, and therefore the other part of the economy which is growing, which is a superannuation system, that it ends up owning the property and leases it back to its members, so the members don't have to worry about buying property. They need just to earn a wage to pay their rent. If that's where we're heading, we better decide that's going to be our policy and get ready for it. What we're having is this exponential growth in property prices unplanned, undisciplined, funded by excessive leverage. You know, the banks are doing fine lending money on unproductive residential property. We're putting a burden over entrance to the property market. But based on what James's extrapolation is, and it's all compounding, every moment you delay entering the property market, you're getting further and further behind the curve and the unaffordability curve. But what he also said is that there's an unfair advantage to those who own assets, to those who own property in particular, or financial assets. As more and more liquidity is created and the effects are compounding, owners of assets are becoming increasingly wealthy. And the divide between recent entrants or the next generation to past generations who still survive and accumulate assets, that divide is getting ridiculously high and dangerous. So obviously I know James and Clime writes for First Links, and I've written an article regarding politicians and their ownership of property underneath his article. I just encourage all our listeners to go to First Links and read these articles, because they are very, very interesting and intriguing. Where are we headed?
Yeah, very interesting indeed. John, just before we go, did the labour numbers create any confidence that the RBA will cut again before the end of the year in your mind?
Well, I've said, Paul, and I reiterate that, the Reserve Bank of Australia, its job at cutting interest rates is much easier when America cuts interest rates. So we've had the first cut in America. That'll be a relief to the Australian Reserve Bank that it can get on and maybe cut again. But it'll be watching the expectations going out further. Is the Federal Reserve going to be cutting interest rates 2 or 3 more times by June next year? That's going to be important. What we got to last night, as you said earlier, not a lot of interest rate cuts expected in America by this time next year. Now, I would suggest that's under a current Federal Reserve which is not overly influenced by Donald Trump. The whole outlook for interest rates changes if he moves the governor or the chairman aside and starts putting his own people onto that board, and they start being more aggressive in interest rates, which is what his edict is. So specifically on our answer, yes, the fact that the Fed cut last night suggests that we can cut again in Australia. Let's be clear, Australia's problem is household debt, the amount of leverage, and as we just, in the previous answer we gave, and referring to James Gruber's article, we are compounding out as a serious problem in affordability of property. People bridge the gap in buying property by borrowing. They have to service that borrowing. Park that fault. It's no different to the American economy as a whole, the American government, which is running $2 trillion deficits and is now being hammered by rising interest rates, not because interest rates are going up the way we see it in terms of interest rate cuts, it's because they're rolling debt which they issued prior to and during COVID at ridiculously low rates. They're rolling a lot of government debt into 3 and 4% rates from 0 to 1% rates. Okay? So American government's got to get its interest rates down. So the Federal Reserve's got to get interest rates down in America so the American government can service its debt. In Australia, the RBA's got to get interest rates down. So a very highly geared household sector, those who are geared, can pay back their debt. Very similar problems in different parts of the economy.
Yeah. John, thanks so much. We will have to end it there. And as always, an interesting discussion. Thanks, John.